Welcome to the Modern Arizona podcast. Today's podcast is a little different. It's from one of our live events with the Modern Divorce Navigator, designed to make divorce less stressful and more manageable. If you enjoy the podcast, don't forget to subscribe. And if you're curious about the Navigator, check out the link in the description. We would love to have you join us. Now let's dive back into the episode. Welcome, everybody. Post-holiday, it's our first guest special show, and we are joined today by my brother, Michael Tarascio. Hi, Michael.
Hi. How are you?
I'm so good. I'm glad that you're here. So today's topic, we're going to be talking about setting yourself up for financial success in 2025. Michael, tell people a little bit about your background.
Sure. Yeah. So I have a fee-only financial planning firm. Here in Arizona, we have a location in Portland, Oregon, here in Gilbert, Arizona as well. We work mostly with self-employed folks. We work with companies, small business owners. We'll manage their 401k plans, and we do excellent financial planning. So topics like this are really commonplace, especially this time of year.
Yeah, now is the time, right? People are post-Christmas. They're looking at their credit card bills and went over budget, and they're wondering, how am I going to set myself up for success, and what should I be expecting for inflation? So when you meet with people, what are the first things you dig into to try to help people figure out how to set themselves up?
Yeah, what a topic. So broad. I mean, there's just so many different areas that it's an important thought exercise to go through. Where do we start? Because it can be super overwhelming. You hit on something there that I think is a good starting point for this time of year. Reports have shown that American consumers spent a lot this year, which is good. It's good for our economy.
Good for the economy, bad for the household.
Yeah. So that's probably a really, really good place to start. And there's no secret sauce to that. Like, when we hit January 2nd, take a look at what the damage is and pay it off. Don't bury your head in the sand. Hope that it's not as bad as you think it is. Let's just see what the damage was, and we probably need to pay it off, because nobody likes paying 29% interest on their credit cards.
No. Okay, so top priority, pay off your credit cards.
I mean, for this time of year, yeah. So for most of the folks out there, when we talk about setting yourself up for 2025 for success, the questions are, what are some quick hitting action items that I could do now that aren't overwhelming, that'll make a material difference in my life this year? So a lot of the things that we're looking at are, let's look at low-hanging fruit, and let's check those boxes. So there's two topics that we're talking about a lot. One is, and I talked about this with the modern law team, make sure you're not giving the IRS a free loan by having too much of your paycheck withheld for income tax this year. So, and we'll get into the details there, but that's number one, because that's low hanging fruit. That's something you could do right now.
Right.
It's not that painful.
Yeah.
And then number two, this topic comes up a lot. I find it really, really interesting. Everybody wants to make more money, which is good, right? We want to do that. Sometimes we're making it harder on ourselves than we need to. So if you're employed at a small business, mid-sized company, or a large publicly traded company, I would say look first to your own bonus structure.
Yes.
Before you start investing huge amounts of time, resources, and money in setting up a side hustle.
Yeah, that's such a good point. People often overlook the low-hanging fruit of, how do I get my employer to give me more? And that could be in terms of matching a 401k contribution, or in terms of, how do I work smarter? And if I'm going to work harder, how do I work harder and get more as quickly as possible?
Yeah, that's exactly right. So the conversation is akin to like an ROI. Where do you get your biggest return on investment? And it's important to not overlook how much time and effort and energy would go into setting up like a serious side hustle to bring in more money, because it's a big investment of time that you're making. And if you take a step back and you realize, hey, maybe I'm not hitting all of those qualifiers at work, those performance-based qualifiers that would lead to a multiplier payout. oftentimes it might just be a small tweak of your behavior at work. Maybe it's a few more hours every week that needs to go into performing a little bit better. But that small investment of time can lead to 20% more income, 25% more
Oh,
income.
man, you're totally right. I mean, it must depend on the business, right? Not everybody
Sure.
has the ability to bonus, but there usually are ways, right? In every company, there are usually ways. Your employer is trying to incentivize something, and they might be willing to pay you for, I don't know. I mean, when I worked at the Gap, it was opening credit cards. And, this was a long time ago, obviously, but I worked at the Gap. And, if you sign people up to get that extra 10% off, you got like $25 a time. And so, like, just, I guess, turn it on the hustler, no matter, doesn't mean you have to go start your own business or a side hustle. And what are the numbers currently on side hustles? Are those in decline?
I haven't read that they're in decline. So I think that side hustles and the gig economy is alive and well, and it's a real thing. I think maybe to the contrary, because it's so alive and well, a lot of people will look to that as the first go-to for how do I make more money at the expense of, hey, this is right in front of me. It's some small tweaks. And you're totally right. I was talking to Marjan, my wife, about this yesterday. We were talking to our kids about working as teenagers and how I worked at McDonald's. That was my first job. Marjan worked at Hollywood Video. And she said that at 16, it was her first opportunity to learn how to sell. People would come in and rent movies, and she would try to upsell them on, hey, let's get you a soda and red vines and blah, blah, blah. Hustle. It's the hustle. And she was compensated for it.
She was. Okay. All right. All right. I love that so much because it's such a smaller ask of people. Instead of asking you, go make more money by moving companies or getting a new career or going to college, it's simply look for the low hanging fruit.
Right. Yeah.
How do I make more money doing exactly what I'm doing and maybe doing it a little differently? And then going back to the IRS thing, people really like that refund check, Michael.
Yeah, they do. They do. So let's talk about that. They shouldn't.
Yes.
They shouldn't like the refund check. They should, like, it feels so good and people brag about it. And there's whole industries that spring up. Get your refund. It's refund season. That is BS. That's nonsense. It shouldn't exist. Refund season is your compensation from the past 12 months. You worked hard for it and you gave a free loan to the IRS and they didn't pay you any interest. And that's the only time that can exist. I mean, if you wrote a loan to your family member and you didn't charge interest, the IRS would come in and say, no, we're going to force imputed interest on you.
Yeah.
So don't give the IRS a free loan.
Yeah.
It's much better for all the right reasons to not get a big refund, not the least of which is studies have shown that when people get these big refunds, they splurge and do things that they have regret for later on after that. So, yeah.
Right. Instead of building this into a plan of how do I set myself up for success, it feels like the lottery and you can just go, play with it. But one of the things that I've heard you suggest to people is that they take a look at their withholdings, they figure out how much they're over withholding, and they redirect that to their 401k and increase that contribution there.
Right. Yeah.
So they're not taking a hit to their household income.
Yeah. No. To the contrary, it increases. And they haven't done anything. And so let's talk about it. This is an important conversation. So let's say you work at a big company, you're a W-2 employee, and you don't give much thought to what your net take home is. You should. And it starts with some of these big deductions. One of the biggest deductions that's forced on us is income tax, federal income tax. So oftentimes when you're a new employee, somebody may decide that for you, or you may just go in when you're onboarding and just kind of check a box, and it needs to be looked at again. So let's go a little deeper with this because it has to do with our tax system here.
Yeah.
A lot of folks will think about what tax bracket am I in? Oh, I'm in the 22% tax bracket, or I'm in the 24% tax bracket. And they'll aim to have that much money withheld from their paycheck. I'm in this tax bracket. That's what I'm going to have withheld. And we're kind of doing it. We're doing it wrong.
Right.
That tax bracket called a marginal tax bracket. That is not the actual rate of tax that you pay.
Right.
There's several reasons for that, but the biggest reason is that we have what's called a progressive tax system. And that just means that different chunks of your income are taxed at different amounts. So in lower amounts, because as you make more, we progressively pay more in tax. That coupled with credits and deductions like the standard deduction mean that the actual rate of tax you pay is usually less than that tax bracket you're in. So let's get back to the person who's onboarding who thinks that they're in the 22% tax bracket and they have 22% withheld. You're probably having 2 to 10% more withheld than you should have.
Yeah.
So real easy activity. And I would suggest everybody go do this around the beginning of the year. Take a look at your last tax return and find your total tax that you paid. It's on page 1 of the 1040 and divide it by your taxable income. This is going to give you your average tax rate. And if you think that this year is going to be substantially the same as last year, this is probably around the amount that you want to have withheld. So if your average tax rate is 17%, you probably want to have around 17% withheld. It means you're not going to get a big refund, but it means also that you're not giving a free loan to the IRS and you're holding on to more of your own money that you earn.
Yes, absolutely. I have some questions here from people in the chat. Financially, I'm drowning. I'm stressed because I had savings and I used to be used to being the sole provider during our marriage. During the marriage, I had to empty my savings to my ex. So probably she had to maybe buy out her ex. Now I have 2 mortgages, 2 households I'm supporting. So yeah, that's how anybody feels when they are the person who makes more money and they get a divorce, because you're not only taking care of your household, you're transferring some of that in terms of child support or alimony or a buyout to your ex. So a lot of people are probably feeling that. Any advice for those people?
Well, I mean, with that particular question, I mean, I think it definitely warrants digging in a little bit more. If you have divorced, but now you're left with both sets of liabilities. I mean, Sherry said that they're paying for 2 households. Seems like maybe we're not on the other side of the divorce where it's finalized. But I mean, you probably, when you divide assets and liabilities, you shouldn't be left with all of the liabilities, obviously.
Maybe an overstatement. Sometimes people say I'm paying for both households when they're paying child support or alimony in addition to taking care of their own household. Here's what I can tell that person, because I've seen this a gazillion times.
Yeah.
The higher earner ends up better off post-divorce. And you may not feel it at the moment. At this moment, you may feel like this is so unfair. They took everything. I'm having to buy out everything. But I can promise you, as time goes on, the higher earner makes more and more and more. And the child support obligation doesn't go up. And the alimony doesn't go up. And your spouse who didn't invest in their career and didn't make money, they're going to stay exactly where they are. So you actually cut your losses and you're going to be better off financially later. I know that doesn't help now. Yeah. But it's true.
No, I mean, it makes total sense. I mean, especially if the expense that you're left with, alimony, maintenance payments, child support is relatively fixed, but the earning potential of that higher earning spouse isn't fixed and it can go up. But I think it's an important question and we should talk about it, because the heart of the question, I think, is what do we do in the thick of it when we're saddled with all this?
Okay. They're looking to sell a previous property, which hopefully they think will sell the next quarter when real estate picks up, and then they will feel financially very stable and they want to know what to focus on. I've stopped due to my budget. I reduced my 401k contributions and my 529 contributions. What now? Okay, so they're planning now for extra money. What do they do once they have that extra money?
Sure. Yeah. Well, I mean, I would say, let's say the divorce is finalized and assets have been divided and you have a windfall, you have extra money. I mean, the first thing is kind of back to basics. So how much financial damage was done from the divorce? Are you saddled with like high interest debt that needs to be satisfied? If so, I would probably look at that. I mean, do we have large balances on credit cards that were used to finance some of that divorce? That needs attention first and foremost, especially if we're talking about a high earner.
Yeah. Would you do that before contributing to the 401k? even though you're losing the free money from your employer's match.
It's a case by case basis,
Okay.
but I would,
Yeah.
because the thought of paying 29% interest
Yeah.
to discover Capital One makes me nauseous.
Yeah.
It's a deal breaker for me. So
Yeah.
I'm saying you can afford to be a little flexible in these tough moments in life. As a rule of thumb, never leave free money on the table, especially with the effect of compound interest over time. But don't pay Capital One or Chase Bank 29% on a Sapphire card. Don't do that. Let's retire that debt.
Yeah.
Definitely.
And you can figure it out. You can figure out how much would I get from my match versus how much am I going to pay in interest. And you can figure out what's going to cost me more. What's the better place to put my money. But yeah, it's true.
Exactly.
Those credit card companies, they make so much money, and it feels a little unethical, doesn't it?
Yeah, it feels icky. It feels unethical, and there's a reason for it. It's because when else do we allow lenders to charge up to 30%? I mean, the credit card companies have lobbied hard for that. So I would say, yeah, I would say do that. Try to knock that out as quickly as you possibly can. Then when you're coming up for air, hey, do you have an emergency fund? Even if you're a really successful high earning person, it really does need to be number one, because emergencies happen. So let's replenish an emergency fund of at least 3 to 6 months worth of living expenses. Then let's aggressively get back to contributing to our workplace retirement plans, and at least up to that company match, because money.
Are there still big high yield savings accounts available?
Yeah.
Yeah.
Yeah, absolutely. So even though rates have come down a little bit in the last 10, 12 months, you can still go to find a high yield online savings account, which is we talk about this a lot with a lot of employees that we do 401k education with. So there's two different types of accounts that pay a high yield that are both liquid. One is a deposit account, a bank account that's FDIC insured. And you can go online like Marcus or SoFi, for example, and find those high yield FDIC insured savings accounts. It may be a little gimmicky. There may be some hoops you have to jump through, but it might be worth the insurance and the liquidity. There's also money market mutual funds, which you can hold within a brokerage account like at Vanguard or Fidelity or Schwab. I love these. And with those are also insured, not by the FDIC, but by the SIPC, Securities Investor Protection Corporation. In those, you're owning shares of a mutual fund that hold a stable value of $1, and the interest that gets paid on those shares are still really high. Maybe at Vanguard, it might be 4.7%, I think.
Yeah. So, at Modern Law, we need to have savings of 3 to 6 months of operating expenses. And that's a high number.
Sure.
And Michael told me, like, what are you doing? Leaving this in the savings account, go put this in a high interest savings account. And, the company got paid thousands of dollars just by moving our savings account. Thank you, Michael.
Yeah, totally. Well, this is when it's important to take, at the beginning of the call, I reflected briefly on the fact that there's so many different topics, and this is one that's really, really important. Interest rates are high, so it means that it costs a lot of money to borrow to buy a car, go to school, or buy a house. But the flip side of that is that on these accounts, the interest rate is also high. So take advantage.
Right.
You shouldn't have excess savings sitting in some checking account that pays you 0.01%. Look into the high yield savings accounts, look into the money market mutual funds. That's what I do for my firm and for my family personally.
Next question we've got. During the marriage, we were co-owners of a business that had $435,000 of income, but $510,000 of deductible expenses. So we generated a loss of $70,000 a year for the company. Some of those, I need to tell my kids to stop yelling.
Who's that? Take your time. Yeah. Okay. So we're going to find out how we have $70,000 in ongoing deductible expenses. I hope it's not too ongoing year on year. That can definitely raise some red flags.
Okay, so we've got our business, which is generating a loss of $70,000. Some of those deductible expenses were paid for by me personally, and the majority of the deductions were paid by the company. How do I set myself up to reduce payments to the government in the form of taxes? I make $100,000. So they're going to be a W-2 employee is what I'm gathering. from their business and they make $100,000 salary, but then the company is generating this overall loss. How do they figure out withholdings? Because they're not paying any tax if you have a loss.
So let me see if I understand. Is that the question? The question is on her personal withholding?
How can I set up myself to reduce payments to the government in the form of taxes?
Sure. So likely the question is on her being a successful business owner, and probably one of the biggest headaches she has are the quarterly estimated tax payments that she makes. I hope that's the gist of the question there.
That could be the question.
So if it is, I mean, in a sense, she's already doing that. As she stated, she has more losses than income. And so when you do that, you if you have no income, you are not paying tax since there is no income there.
Right.
If we
You are going to pay tax on that $100,000 that you're getting in salary. And right, the general withholdings are going to come out of that. And then you're going to have your Social Security and all those, right? But then will you not pay income tax on the 100?
Well, so let's say, for example, the company that she's talking about is a corporation, and she, as an owner, is one of several employee shareholders, and so she has $100,000 of W-2 compensation income. So she's gonna get a direct deposit of that income. That, in addition to some of the other expenses, may leave the business itself with losses that'll show up on its profit and loss statement at the end of the year.
Right.
So if she wants to know how she personally, as an employee shareholder, can reduce the tax she pays on the $100,000 of W-2 compensation, well, the easiest one is to max out the 401k plan, which let's hope the company has that. If she's under 50, she can defer $23,000 as an employee, deferring with elective deferrals. If she's over 50, there's a catch-up contribution. And in 2025, the max she can defer is $31,000, which is a lot of money.
Yeah.
I mean, that's $31,000 on which you're not paying tax. So those are the biggest ones. Health savings accounts, if she's eligible through her health plan, is the most tax advantageous account that's out there. So I would.
Can we talk about that for a minute? Because I don't know that everybody knows this. This is really cool.
Sure. Yeah. So when we say it's the most tax advantageous account that's out there, it's really true. And the reason is that there are deductions almost at every transaction. Every time money touches the account going in, going out, if it's a qualified touch point, it's deductible expense. So let's say this person who wrote in is eligible to own an HSA. If the employer, which would be her in this case, makes a contribution, that contribution can be qualified, which means the employer gets a deduction for making a contribution. If she, as an employee, makes a contribution, that contribution is a tax deduction for her as well. Then, during the life of the account, the funds that are in the account that hopefully are invested and invested well, they grow tax deferred. So every time there's growth each year, there's no tax consequence for that. That's the third tax benefit. Then when qualified distributions are made to reimburse for healthcare expenses, that distribution out of the account is also not taxed. So that's the fourth tax benefit that one gets with that account.
Can that only be used forever and ever for health expenses?
Wonderful question. Yeah. No. Well, so let's take a sec, answer the question. No, you can take a distribution from the account, but if it's not qualified, that may result in income tax and possibly a penalty as well.
Okay. All right. So this person added to their question, taxes have not been paid by this business or them personally since 2021. The judge has ordered the other party to submit documents and have the 2021 taxes completed during the divorce. With the new rule a couple of weeks ago, the taxes for 2022, 2023, and 2024 need to be completed by the end of January 2025. I don't know about that rule.
I don't know which rule she's talking about. There was a recent ruling on beneficial ownership interest for small business, but that was a couple of days ago. I don't know which ruling she's talking about.
All right. Well, business was awarded to the ex. Taxes haven't been done. What does somebody do if they find themselves in that situation? Because it happens a lot where people don't always file their taxes.
Can be a problem. So what we're talking about is tax planning in the course of a divorce. So if assets were divided and one of the assets was a business and it was awarded to the ex, if the business is held to be liable for unpaid taxes, and now the ex-spouse is the sole owner of the business, it could be a problem. Well, it could potentially be a problem if they're still filing their taxes as married filing jointly. Because if there's a liability and she is still on paper at least an owner of the business, then she can still be held liable for the unpaid back taxes for the company. So really important to see how you're filing your taxes and if both the assets and the liability of the business have gone with the act.
Yeah, absolutely. Is the tax liability given to someone, assigned in the divorce, is definitely a question you need to make sure to get answered. But the other thing is sometimes people will not pay taxes for years and years, but they're still having withholdings taken out. And they may be so scared to go file their tax returns because they haven't filed in 3 years. And then when you file, if you've been paying in, the penalties are actually a heck of a lot lower than you might think because you've paid your taxes. So if you're in that situation, you're sitting there, you haven't paid in a long time, you're freaking out, or I'm sorry, you haven't filed in a long time, you're freaking out because you haven't filed your taxes, go see an accountant. Like, go through the process. It may not be as bad as you think it might be.
Right. Yeah. No, I think that's important. And, one of the keys there that you mentioned is if you have been paying taxes along the way.
Right.
So the IRS will levy penalties for taxpayers for failing to file and for failing to pay.
Yeah.
So if you just failed to file, you may not be in as much trouble as you think if you paid along the way.
Right.
You're going to be hit with some penalties and interest on those penalties that haven't been paid if you failed to file. And just like the conversation, the topic at the beginning of the conversation, don't bury your head in the sand, especially not with the IRS. Go see what the damage is. Let's settle up in 2025 and
they will
we'll
negotiate.
Come up with a plan.
Yeah. They will negotiate. So that's the bottom line. No matter where you're at in 2025, the best thing you can possibly do is get real about your financial situation and make a plan, right?
Totally true. Totally true.
All right. We have so many questions and we are officially out of time. Do you have time for one more?
Yeah, we could stick around. That's fine.
Okay. All right. If you got time for a couple more, there's a lot in here. How can I protect my assets if I plan to remarry or blend my family post-divorce?
That's loaded. I would say it's important to ensure that the divorce is complete and both assets and liabilities have been thoroughly, properly separated. And I would go speak with a very, very qualified estate lawyer moving forward, who can set up an appropriate type of trust designed specifically to, protect against creditors coming out of the woodwork, including like an ex-spouse who might want to make a claim. So that's what I would do. I would find a good estate lawyer, talk through your concerns about future parties making claims on your current assets, and probably set up and establish and fund the right type of trust that would meet your needs.
Good advice. That is got to be your best case scenario. But if you're not going to go get a trust, at least you need to keep your assets separate. Just getting married doesn't make your assets that belong to you now part of your marital property or community property. It doesn't. So you must. The biggest problem, though, is that people go and buy houses and then they stick both names on it. And then what have you done? You've taken your money that you earned pre-marriage and you've made it now a community because you've gifted it to the community. So that is really important that you don't do. And if you plan to do that, let's say you're in a position where you're getting remarried, you've got $100,000 that you want to put down on a house that you want to live in with your new spouse, that you want to co-own with your new spouse. There is nothing preventing you from having a written agreement about how those proceeds would be handled in the event of a divorce or breakup. Please do not kid yourself. Second marriages fail more often than first marriages. You've already been through this once. Please set yourself up for success. And you can do that. You don't even need a prenup. Like, let's say we're making a deal about the house that we're buying in my hypothetical example. you can have an agreement about that house.
Right. Yeah. Yeah. I mean, you're more of an expert in the area than I am, but yeah, I would agree. I would go in with an agreement signed, eyes wide open with both parties on what's going to happen to assets that you bring into this new relationship, domestic partnership or marriage, in the event that that relationship, marriage dissolves. So
Yeah.
yeah.
Yeah. Okay, last question we'll take. I'm new to managing investments. What are some beginner-friendly strategies to start growing my savings post-divorce?
Yeah, wonderful question. So we're new to all of this. We're new to saving. We're new to investing. What are some strategies that we can implement? So, your best friend and one of one free lunches that you can get is diversification when you're new here. So the first thing I would do is just jump in, set up your 401k at work, set up the brokerage account, set up your IRA, make the contribution. I would buy a diversified index fund like the total stock market or like an index like the S&P 500. And you're going to be really, really diversified. It's going to protect you from having to go and pick individual stocks, which is a risky proposition. You want to minimize your risk and you want to be as diversified as possible. You want to own low cost passive funds, and you just want to continue to be involved. So by that, I mean, don't take the money out. So be diversified by owning index funds, and time is your friend. We've talked about this in the 401k. The effect of compound interest is wildly powerful. So even if it feels simplistic, it's often much more potent than like day trading and trying to beat the market. Be diversified, be invested, and stay invested, and allow the magic of compound interest to do its wonders.
I love that. I love that. Okay, so thank you all for coming and for sending in your questions. If this has been helpful, make sure to let us know, and we can get you Michael's direct contact information if you want to go over your situation directly with him. Thanks so much for listening to the Modern Arizona podcast. If you've enjoyed what you've heard today, make sure to download it, like it, leave a review, and share it with your friends. If you know someone who would be a good guest or you would like to be on the Modern Arizona podcast, make sure to give us an email or reach out to us at mymodernlaw.com.